Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Acasti Pharma stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Acasti is a biopharmaceutical company. It focuses on the research, development, and commercialization of prescription drugs for the treatment of cardiovascular diseases. Its main product is Capri, an omega-3 phospholipid therapeutic that's currently in the third phase of clinical trials. This is to treat patients with abnormal concentration of triglycerides in the blood. This is a chronic condition affecting 1/3 of the US population. Its other product is Trilogy, that is also in phase 3. It will be used to evaluate the safety and efficacy of Capri. The company's headquarters are in Laval, Canada, and it started in 2002. This company trades on the Vancouver Stock Exchange. The ticker is ACST. We're going to look at the ticker that trades on the New York Stock Exchange. That's the same ticker, ACST. Let's get started with the model. This is a micro-cap company, 215 million market cap. They're trading at $1.20 a share, and they have 180 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have negative net income every year. Revenue is a sales for the company, and they're pre-revenue, so they have no revenue. This is the company's income statement. The top line is the revenue, the sales. Below that is our operating expenses. Research and development is a common operating expense for a company like this. Also, the cost of supplies and materials. Below that is operating income, and of course they have negative operating income every year. Below that is the interest they pay in their debt. Below that is other income and expenses. This is usually impairments or other non-cash gains and losses. Below that is their pre-tax income, and they're not paying any taxes since they have no profits, so they have negative net income every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And the company has negative free cash flow every year. So in order to run their business, they have to issue capital stock. They issued 8.5 million in 2018, 43 million in 2019, and 7 million in 2020. Each time the company issues capital stock, it dilutes the current shareholders. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. This company, of course, has negative operating cash flow because they're pre-revenue. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And to calculate operating cash flow, you start with net income. Then you have to add back the 2.3 million of depreciation. Depreciation is a non-cash expense that brings down your net income, but it doesn't affect cash flow. They also had 2 million in stock-based compensation and negative 3 million in changes in working capital. Even though they reported a $25 million loss, they actually lost 23 million of cash flow from their operational business. Let's look at their capital structure. They're almost all equity. They're 99% equity, 1% debt. And their WACC is 14.1%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's 477 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $307 million. We divide that by 180 million shares. And we get a calculated stock price of 171. They're trading at 120, so they're trading at a 30% discount. It's a buy according to the model. Simply Wall Street values the company at $358, so they're saying the stock is 66% undervalued. Since the company's pre-revenue, the future valuation is an assumption that their products will get developed and they'll have some commercial success. Of course, that may not happen. This is the company's stock price the last 5 years. So it looks like it peaked at almost $3 at one point, but it's come down since then. So people are really investing in the hopes the company makes money in the future because it hasn't made any money yet. There are 2 analysts looking at this stock, and their average price target is $2.52. This stock has a beta of 1.52, so the stock moves 1.5 times the market. The stock has gone up 107% in the past 52 weeks, which is better than the S&P 500, which went up 16% in the same time frame. The 52-week low was 17 cents, the high was 122, and the stock is trading above its 50-day and 200-day moving average. This is a really liquid stock. About 50 million shares are traded each day. Of the 179 million shares outstanding, 176 million are on float. Less than 2% of the shares are held by institutions, and a little over 1% of the shares are shorted. The biggest shareholder is Neptune Wellness at 1.7%, then Two Sigma, then BMO, then George Haywood, who's an investor, then Oppenheimer. Let's look at their financial ratios. The average PE in the market's 10, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They don't have any sales, so we can't look at the price to sales ratio. Price to book is stock price over book value per share. They're at 16.6, and the way you calculate book value per share is equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have 13 million of equity, 9 million of tangible equity, since they have 4 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can easily cover their current liabilities, and their current assets are 14 million of cash and 1 million of prepaid assets. So it does look like the company will need more funding to get through the next 12 months because they had negative 23 million of free cash flow and 9 million of working capital. So a company like this will just do capital raises every now and then when they need cash. And they will continue doing that until they develop a product that's profitable or until they go out of business. The best way to look at ratios to compare them to similar companies, I've done videos of 9 companies in the same industry as Acasti. And if Acasti has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're worse in PE because they're negative. They don't have a price-to-sales ratio. They're a little better in price-to-book than average. They do have a good current ratio, but they're below the average in this industry. They have a terrible ROE. They have hardly any debt, but they're a really small company, much smaller than everybody else. So to summarize, I do have them trading at a 30% discount, but of course it's very risky investing in a company that's pre-revenue. Developing medication is very costly and time-consuming. There's many phases of the process. It could take 10 plus years to develop a product, and sometimes after spending that much time trying to develop it, it may not go anywhere. But that's the risk you take when investing in a company like this. So I rank their free cash flows 1 out of 10 because it's negative every year. Their revenue 1 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.